You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options. Facebook.com/TheOptionsInsider or via questions at TheOptionsInsider.com.
It's time for Volatility Views, the premier program for volatility traders. Each week, we'll take a deep dive into the world of volatility with in-depth analysis, trading activity reviews, strategy breakdowns, cutting-edge education, and much more. We'll also bring you exclusive conversations with the traders, researchers, and asset managers who are reshaping the volatility landscape. If it involves volatility, then you'll find it on Volatility Views. Volatility Views is brought to you by Russell Investments, home of Russell Indexes, which calculates approximately 700,000 benchmarks daily, covering 98% of the investable market globally, including more than 80 countries and more than 10,000 securities. Approximately $4.1 trillion in assets are benchmarked to the Russell Indexes. For more information on Russell Indexes and RVX, please visit russell.com/indexes. And now it's time to take a deep dive into the world of volatility. It's time for Volatility Views.
All right, everybody, you know what that music means. It's time once again for Volatility Views, the premier program for volatility traders. My name is Mark Longo from theoptionsinsider.com, as well as from the ever compelling, ever exciting, ever interesting Options Insider Radio Network. If you want to check out some of the other shows on our network, of course, I'm sure many of you also listen to the Option Block, a very fine program we also have for some of you more basic options traders out there. We, of course, have Options Bootcamp and Options Playbook Radio. If you're into the tech side, check out our latest edition, Trading Tech Talk Radio. A few of you out there may be in the financial advisor, asset manager realm, perhaps more than a few of you, actually. So make sure to check out our Advisors Option Program. If you're into the dark side of futures options, then check out either the long and short of futures options or even Futures Options Roundtable. Two choices for you there. A lot of great choices. And of course, if you want to check out all of our latest updates, check-ins, interviews, our Charlie Rose for the options market, we call it, then check out our Options Insider Radio program, our flagship premier interview program on the old network. I'm forgetting a few in there somewhere. There's quite a few shows on the network these days, but we've got something out there for you. And you can check all those out in one fun and easy to find place. Check out the Options Insider Radio app, available for iOS, Android, and Amazon Kindle Fire devices. You can instantly stream all of those shows wherever you have signal, and even some places where you have pretty weak signal. You can still get those programs. Of course, you can download them for offline listening. And then if you have a question, you have a comment, you say, you know, that Andrew guy in that Volatility View show, he's kind of crazy. I completely disagree with him. Let us know. Hit that email, hit that feedback button. In fact, we built most of that into the app to make it even easier for you. You can just hit that feedback tab and you can email us directly. You can tweet us. You can send us a Facebook message. You can even leave us a voicemail directly through the app. It's pretty cool. Check it out. The Options Insider Radio Network app, available for pretty much every device under the sun. All right, and joining me on the old Volatility Views panel today, speaking of that crazy person, let's start with him, beaming in from the hinterlands of Maine, none other than the rock lobster himself, Mr. Andrew Giovinazzi from OptionPit.com. Mr. Giovinazzi, welcome back to the program. Sir, it has been too long.
I know. It has been at least, I think, a week. At least a week until I've been, and Vol Views, man, it's been a month or more, at least.
So this is a program, just to refresh your memory, where we talk about volatility.
Is that the jiggly thing that makes the options move around?
I think so. I think the jiggly thing is a technical term. You can find it in the Natenberg and Macmillan books.
Well, you know, we're trying to encourage people to hit that respond button on the Option Insider app. So we have to use those terms, those technical terms, to really confuse people. So jiggly thing.
I like it. I like it. Let's pack the show with technical terms. And speaking of someone who likes to pack the show with technical terms, we are also joined by Mr. Jared Woodard, the research major domo over there at BGC Partners. Jared, welcome back to the program, sir.
Hey, yeah, it's great to be with you as always.
So without further ado, let's dive right on into our volatility review.
It's time to break down the latest developments in the volatility trading world. It's time for the Volatility Review.
All right, listeners, welcome to the Volatility Review. You know what this means. This is a segment where we break down the week that was from a volatility perspective. And unlike some of our other recent weeks, this actually had a little bit of movement, a little bit of action, a little bit of vol being exhibited. Not a ton, mind you, but some out there in the recesses of the S&P and indeed the VIX. So we will start there. It was, like we said, actually, as we were recording last week, let's go back a little bit, we finally dipped south of the 11 handle in the VIX cash, got into the 10 handle range as we were recording, so we didn't get a chance to really pontificate on that last week. Came into this week, of course, still on the lower end of that spectrum, but back into the 11 handle range. And then we saw some developments in the Middle East that seemed to give a little bit of juice, a little bit of spark back into the old VIX. We got back into the 12 handle range in the VIX cash. And as we are recording this today, listeners, Friday, June 13th, the VIX cash hovering right around that 12 handle as we speak. So it was an interesting week from a volatility perspective, little stuff going on. Andrew, since it's been a while since you've been on the program, perhaps we'll start with you. What caught your eye? What did the week that was from a volatility perspective mean to you, sir?
Well, it means the market can still move. Fall in general, it has been, and this is, I think, we have, I think Al Qaeda kind of running south with guns blazing. U.S. is kind of sitting watching them do it. VIX goes to 12. That's all you got to hear. It makes the giant move from 11 to 12. Potential disrupting oil supplies. You got lots of Islamic terrorism thrown in there. I would say, in the old days, that might have been good for 2, 3, 4 points in the VIX. Today, 12 handle. That's what we got. And he actually, even today, President came out, said, we're looking at the situation. I don't think he really changed what they were looking at. Vol didn't move much. And I mean, into the close, you're getting a little bit here for the treasuries, but they're taking the weekend out. So VIX is trading 12.05. Probably, I would be surprised if it kept going lower today. But ultimately, you know what? Unless something really awful happens to global oil supplies, the market is totally shrugging this off. Volatility, totally shrugging this off. Like, it doesn't matter. Global growth is for real. And the VIX is saying poo to the whole Iraq thing. I mean, look what happened last year with Syria. Remember that? We had pretty good jump in vol. I mean, it's kind of a similar situation, and we're getting no response from volatility. So, kind of different universe, it feels like.
I love it. Another technical term for volatility. VIX says poo to you. Perhaps that'll be the title of our episode.
VIX says poo to Al Qaeda.
Sounds like you've been hanging around my 5-year-old, sir. There certainly is no reluctance in this market to take the weekend out. You would think with some quite literal weekend risk this weekend, who knows what could happen over there? They could launch aggressive attacks. You'd think you might want to have a little bit of premium in your back pocket. You might be a little bit reluctant to hit that bid, and yet we're not seeing any signs of that. You're right. They're selling off the VIX yet again, off about half a handle in the VIX cash, and the futures taking on the chin a bit as well. So you're right. Not exactly a reluctance out there for what's been going on out there. So yeah, perhaps that does speak to, I hate to use the word because we've debunked it often on the show, but perhaps a bit of complacency throughout the broad options realm, at least when it comes to selling vol going into the weekend. Jared, what was your take on the week that was from a volatility perspective, sir?
Complacency in the absence of risk is no vice, is my tagline these days.
Is that what it says on your business card?
Yeah, I mean, that was the title of a recent thing we put out, and I'm just kind of sticking with that theme because I hear the concern that people have, but when there's no plausible scenario for a major correction, when there's no real risk that we can imagine, when all the data is coming in so strong, when monetary policy around the world is configured in just about the best way that anyone could want it to be given these circumstances, it's just hard to imagine what people could actually be complacent about. I mean, you can't be complacent unless there's some risk or some danger that that you ought to be attending to that you aren't. So in this kind of setup, whether it's U.S. economic data, which has just been coming in consistently positive, it's really strong in some cases, job openings at the highest level since 2007, consumer credit and lending breaking out from the malaise of the last few years, auto sales on fire, household formation. I mean, it's hard to look in any direction and not find an economic indicator in the U.S. that isn't looking sunny, if not, maximally, upward, at least positive for sure. Japan is having some real meaningful success now in spite of the tax hikes that they enacted this year. We know that the euro is fine and that the eurozone is on a sustainable, at least a generally positive path. So again, it's hard to imagine what the risk would be that would warrant backing up the truck in order to buy premium.
Yeah, just to continue your devil's advocacy there, sir, there are certainly a lot of indicators in your favor. Even with this big development in the Middle East, realized vol in the S&P still not lighting up the tape. It was about 4.5 last week. We're looking at about a whopping 6 for the 10-day this week, so not a huge bump there. 30-day, still only hovering around 8. Again, that's a 30-day, so that wouldn't move as much, but still, a realized vol still trading at a amazingly steep discount to even these low quote-unquote levels of implied volatility in the marketplace. We did see last week a little bit of backwardation starting to creep into the futures as we started getting into the tail end of the week. I'm curious, I don't have my futures up right now here. Andrew, do we still starting to see a little bit of that creeping into the near portion of the VIX term structure there, as people are perhaps getting a little bit up in arms or a little bit concerned about what's going on today, or is it still pretty much par for the course out there in VIX futures land?
Amazingly, the June future is 93 cents over cash.
Oh, well, there you
go.
So
there's zip walla on backwardation. There is hugely steep premium going into the next couple days. So, for those yucky vol products that tend to decay and fall apart, most of the products are already rolling over though to the July cycle. So it's more VIX contracts directly that will move hard next week should the Iraq thing come to nothing and the 13 handle on the future goes to boom boom 12 handle really fast. So, but there's still some substantial roll premium, not as much as there was last week. We had like July future premium was almost $3 at one point. The June was pretty expensive at around 2, for reason, because we went down there to like just below the 11 handle for cash. Now, all of a sudden, things are kind of, I would say, a little bit, we'll just call it more of a normal future premium with basically a full cycle to go for July, about $2. So still not cheap, but, big, healthy future, healthier premiums in those means obviously more fun trades for those volatility products that we read about in the Wall Street Journal this week.
You have to read about them just about every day in the journal these days, and not just the journal, other publications. I do kind of feel bad for those guys. I was actually talking to a few of those guys in some other outlets, and they're like, we can't just keep writing about VIX is low. What else can we write about? So we were trying to give them a few ideas, but still, it is a difficult road for these guys to try to find something interesting going on out there in VIX land. Speaking of VIX land, we just talked about the futures, looking at the options. Not surprisingly, the ADV coming off a little bit, hovering around 623,000. Still amazingly robust for any option product out there, but not at the peaks we've seen in recent months out there in VIX land. Also, the indicator we've been talking about quite a bit on the show in recent weeks, the call to put indicator, very heavy, got spiked up to about 3.4 to 1, has dropped off a little bit. I know a lot of you listeners have written in with questions about that. It has come off a little bit again, down to about 3.1 to 1, so we're off of the crazy historic highs that we saw a few weeks ago out there. But again, as we talked about this many times on the show, the VIX, other systemic factors haven't really changed to really make that indicator lessen up to a greater degree. You still are hovering at the lower end of the range, so there's going to be more activity covering and more strikes available to the upside. Hence, that indicator is going to stay pretty heavy. Looking at some of the active strikes out here in VIX options land, biggest strike to date right now, not a huge surprise coming in the near term, the June 16s, with nearly 400,000 open on that strike. So that's really where the lion's share of the action is these days. Also getting a little bit north out in July. The July 20s also pretty active, nearly 400,000, 370,000 contracts open on that strike, to be precise. Getting into the put side takes a while to actually find a hefty put strike, but you can find the July 13 puts, 355,000 open on that strike, so fairly active. Then getting near term again, June 20s, 277,000, and the July 16s, a little bit more reasonable strike, 260,000 open. People are always asking us too about the crazy strikes. We actually have a letter touching on that if we have time later this episode. And there are a few crazy strikes that have some decent open interest. In particular, the SEP 28s. They have 167,000 open. I believe that was part of that size call spread we saw going up a few weeks ago to the tune of, I believe, 150,000 contracts. So I'd imagine a lot of that is on the on the short leg of that VIX vertical we saw go up a few weeks ago. I'll have to check the strikes to make sure, but I believe that was the short strike there. I believe it was 1928. And then, of course, the June 28th. So the 28th strike pretty much across the board. Seeing some love with 141,000 going up there. And as we're recording today, the top strike out in VIX land, the July 14s, had traded a whopping 74,000 contracts going into the recording of the show today. Of course, we also like to keep an eye on some of the other products like VXST, doing a little bit better out there. ADV still hovering around 500 contracts. That hasn't really budged over the past couple of months. We're still waiting for that product to get the next big tick up in volume. Open interest, though, has started to climb. Remember, we were talking about this last week, listeners, going into the non-farms number. You would think a product like this would see a decent spike in open interest going into the non-farms, yet we didn't see that. That is almost the exact scenario that this product was designed for, is speccing on and hedging against those kind of near-term events like the non-farms. Didn't really see much of a bump in OI going into that event. This week we did. We saw it nearly double to about 3,000 contracts. It was hovering around 1,500 contracts open interest for pretty much the lifespan of this product. And we see a lot of activity right now, or I should say relatively high activity given the volume levels of this product out here in June. This is the regular June contracts. We're seeing the most interest, not the weeklies. 558, the June 18s have about 600 contracts open. The June 20s about 500. And some action actually in the 10-half puts in June as well. 300 contracts open there as well. And then rounding out the VIX-related suite here, looking at our other friends out there in Russell with RVX. Actually has some action out there again. Open interest still hovering around 5,000, which is a pretty decent level for that product. Right now, as we're recording it, there's some interest, seems like in the July 19s, people coming in and scooping up some of those. We'll see if that activity continues throughout the rest of the session. The way this product seems to be trading of late is people just dive into one particular strike at a time. And so maybe today is the July 19s turn. The top open interest out there, like we talked about in the show in the past, the July 26s and 27s both have about 1,500 open each. That was a part of a very, very tight, bizarrely tight one strike spread we saw go up a few weeks ago, as well as I believe it was, it looks like the June 22 straddle went up 810 times as well. So open interest on both of those strikes. And then just for good measure, the June 33s also got 100 open out there. So that's our week that was from a volatility products perspective. And of course, talking about what we were, or as Andrew was referring to earlier, Wall Street Journal talking about a lot of volatility products, and there's pretty much everyone is jumping into the volatility fray, as we said on recent episodes. A lot of the media is beating that VIX is low drum. I got a kick out of an article that was up on CNBC.com. Andrew, maybe you saw this as well. They were kind of going on again, beating on the death of volatility, the death of volatility. It says that the title was "The Death of Volatility Forces Traders to Get Creative." And you scroll through this article, you got some of the usual suspects in here. Then they have this one guy. Well, they mentioned, of course, VIX had its lowest level since 2007 this month. Everyone's harping on that, breaking through the 11 handle into the 10 handle again in the VIX cash. And then they're talking about some ways that traders are trying to gin up returns. And this one guy says, volatility is dead. And as a trader, we live for volatility. So right here and now, we must get creative. What I do is write premium on current positions or spread. For instance, he mentions being long WTI and selling calls aggressively against that position until volatility comes back. So apparently this guy, not a big fan of selling options when there's actual vol in the marketplace. But when there's no vol, that's when he's hitting bids left and right. Is that how you trade as well, Mr. Andrew?
Yes, what we do is we try to sell as many options as we can, as far in term as possible when the vol is super low like this.
I think that's a great. I would call that creative because most people wouldn't come to that conclusion. So therefore,
you know what? Actually, we have a lot of at Option Pit. We have a lot of our clients have actually been trading this low vol environment very successfully, surprisingly successfully, and they actually have got creative. So I'm not going to say it's a secret sauce, but there's definitely there is a way to control your risk in this type of environment. Selling premium, it just you got to be a little bit smarter how you do it. So the thing is I'm looking at what they're this idea just writing options. It's like writing options on Intel, and then today it's up $2, like Intel up $2, crazy. So I think you can position, when volatility gets this low, you want to keep the term shorter. That's all I'm going to say. You want to kind of stay away from, maybe doing too many things that are too long term, because you're just not getting a lot of money for what you're doing.
Yeah, speaking of Intel, that one's on fire today. 82,000 of the OC33s going up today in some massive spread. So yeah, a lot of action on Intel. This was the option block. We'd be digging into that one, I think, today. My old stomping grounds out in Intel, so I like to keep an eye on that one. But you're right, I don't want to beat up on this guy too much in this article because I know how quotes can be taken out of context, but I just thought that was a funny thing to put out there.
Yep.
Vol is low, hit every bid you can see. It's time to start selling options. But you've talked on the show in the past as well that a lot of other outlets that aren't traditional VIX-heavy areas are starting to dive into the fray as well, including The Economist. We talked about them a few times on the show recently, really diving into the VIX debate these days with gusto. They wrote again, calling it the calm before the storm this past issue, and they keep coming back to this. The great moderation is returning in the economy. We kind of talked about that on recent shows as well, about how we're seeing this starting to factor into a lot of products, fixed income, currencies, and of course in the broad equity volatility as well. And their article there kind of went on with about a bunch of different factors that they think may be contributing to that. A couple of interesting comments about VIX, I thought, in this article as well. They said that the VIX only tells us that investors aren't worried about shocks in the near term. The VIX seems to behave rather like ripples in a pond after a stone has been thrown in the center. Turbulence at first, but after a while, serenity reappears. A very cogent statement on VIX, I thought, from The Economist. Not a place I usually turn for my derivatives narratives. They also mentioned some interesting ideas that, we can rule out the idea that volatility is moving to a permanently lower level. Being The Economist, they do mention the Minsky model, saying that investors start to believe this mantra that VIX is low, volatility is low, volatility is low. Guess what they're going to do? Maybe, like that other article showed us, they'll start taking on more risk than they perhaps should. Hopefully not in the area of selling options, but perhaps in scooping some up. But either way, they're going to take on more leverage to exceed their capacity, and then bam, vol comes back into the marketplace. Jared, I know you're a big fan of The Economist over there. What's your take on this? On their take, I should say, on the VIX and volatility, and their notion that the great moderation has indeed returned.
Well, that's an interesting idea. I guess two things come to mind. The first is that it's just striking how much of the coverage that we've seen over the last couple months has been entirely focused on these very short-term measures of implied vol. As we know, there's options going pretty far out in time, and so we don't have to be confined to a 30-day estimate. We can look at longer-term expectations to see if people are pricing in, more or less than has been the norm in prior years. And I think if you look out there, look at 6 months or a year or 2 years out on the curve, it looks like expectations are actually fairly normal. So you might get situations where short-term equity realized volatility is low, like we've had lately, and we can see that pull down those short-dated estimates of implied vol. But even while that's happening, even while everyone's writing about this so-called complacency, it looks like the longer-term expectations for equity market volatility aren't especially notable compared with recent history. And so in that kind of context, I think that the investors who are taking a longer holding period, who are making investments on that basis, probably are not complacent in any meaningful sense of the word. As far as long-term growth expectations, the long-term nature of the market, if we're going to talk about sort of speculative approaches to the future, Isabella Kamenska over at FT Alpha Bill has written quite a lot over the last year or two about the death of volatility, not in the sense of a low VIX or some other kind of very short-term measure, but about the nature of the economy going forward and what changes in the economy, both technological, policy-wise, and otherwise, would mean for the distribution of returns in markets. And I think there's lots of really fruitful thinking to do along those lines about how changes in policy especially will affect what markets act like and how markets act over the next several years. And in that kind of context, I think we might actually see markets over the next 5 to 10 years that look different from what we're used to seeing in terms of cycles in the post-World War II period. But that's a kind of a whole other conversation. In the short term, I think we can be content to see that investors with a 6 to 12-month horizon who are trading options don't appear to be doing anything particularly risky or complacent or unusual.
If this keeps up, I might have to renew my subscription to The Economist. I had let it lapse just because they didn't really discuss a lot of the markets that were most salient to me. But this perhaps marks a bit of a change in their coverage, in which case I may have to revisit my stance on The Economist. You mentioned other indicators looking out longer term and perhaps a bit of a broader perspective, Jared. Well, I know you like to look international as well. And of course, there are a lot of other indicators we keep an eye on as well, and a lot of other indexes we keep an eye on as well, including Bank of America's Market Risk Index. Again, another indicator dropping to near record levels. At this point, it dropped to minus 1.27 on just this past week. That's the lowest reading since 2000 for that indicator. Bear that in mind when you're looking at these things. And of course, JP Morgan has their Group of 7 Volatility Index. That's for the currencies. That also closed at a record low of 5.61. A lot of that coming on the heels of what we saw last week out of the jobs reports and non-farms starting to reduce the fires out there even more. And then, of course, looking at the global perspective, I know, Jared, you like to pay a lot of attention to the international markets. We've been talking a lot about China, and Shanghai in particular seems to be a hotbed of activity, at least from an exchange perspective these days in the derivatives world, but not so much in the actual volume. In fact, volume over there and the shares themselves have fallen to their lowest levels in over a decade. We're seeing the Shanghai Composite's 50-day vol, so a little bit farther out. That dropped to 12.5 last week. That's their lowest level since October of 2003, so well over a decade ago, again, overseas. So, and the index, again, hasn't moved less than 1% on a closing basis for the past 14 days. That's the longest stretch since 2001. So yeah, a lot of narrative coming out of China as well that perhaps people aren't too enthused with the market over there as well, and that's starting to translate into the volatility. Kind of a similar development to what we're seeing out in metals. I know we'll get to metals in a bit, but pronounced sell-off, and yet vol also coming in out there as well. Jared, have you been keeping an eye on the Chinese and Asian markets in your volatility trackers this past week?
I did. We just had an update today, actually. I wasn't talking too much about China, although it is notable that the volatility risk premium there, looking at realized volatility, which you were just discussing as a ratio of equity index implied vol, is at some of the highest levels it's been over the last several years on that ratio basis, rather than just sort of the absolute level of vol. And so it's a situation, I think, where there's very quiet markets in terms of daily trading activity, but also we got to keep in mind that there's somewhere something like a natural floor for levels of implied vol. I mean, there's certainly a number below which traders are going to be pretty reluctant, to sell premium from a market making point of view, and we may be nearing those levels in some of these indexes now. And when you get to that sort of floor below which implied vol is not going to move very much, then when you do see quiet markets like this one, it makes those premium spreads really blow out and look very extreme. Of course, we'll see some mean reversion probably in the statistical measure of volatility over the near term to relieve that extremeness. But the point being that when you have these quiet markets, you can't expect option measures to react point for point with them. While we're talking about East Asia, the success in Japan this year has been pretty remarkable. They were really roundly criticized for the sales tax measure that went into effect this spring, and it looks like data from corporations there, it shows that they've been able to weather those changes and continue to expand. So it's not a done deal yet, certainly, but for all its critics, Austrian and monetarist and otherwise, it looks like Abenomics has continued and is having some noticeable success. The interesting thing about Japanese markets is that sometimes you see increases in equity implied volatility, especially in the indexes, when they rally. We're used to seeing volatility spike when markets decline, but for some structural reasons having to do with the way that structured notes and products are sold in Japan, and for other reasons, you can see implied vol rally even when prices rally. That's not something that's actually that uncommon in that market, and I think that makes it a much more interesting place to trade. So it's something that we do watch quite a bit.
I mean, look at the simple. To me, you get volatility when there's an expectation of realized vol. That's been the key, at least for me, like trading and putting on positions and things like that. When I want to sell calls or when I don't, even if I want to write something. I mean, the Fed is getting out of goosing the economy. We've had 2 years or two, maybe 3 years, probably 2.5 years between Europe and everything else where, the market had crashed to the upside several times. We had somewhere between 1% and 2% moves on the upside, almost with some relative regularity month in, month out, depending on the Fed's going to do this, the Fed's going to do that, Monty's going to do this. And all of that crazy upside is, unless we're having a little bounce like you look today, we're up 0.25%. You're not, without the Fed intervening, we're taking out, a huge piece of the upside volatility. A 1.5% to 2% move is a pretty big move when you're talking about, the major equity indexes. And if they're getting out and they're just letting the economy do what they're doing, we are less prone to shocks, less prone to non-farm payroll shocks and all that kind of stuff, which is basically how we traded for, decades, where the Fed did stuff and nobody cared, which overall led to, generally buoyant stock markets. And as far as risk goes and how it affects volatility, I mean, look at the yield on a Spanish bond. You're really telling me you would rather go buy euros and buy a Spanish bond as the same as a U.S. government bond for the same dollar? And you're getting actually less yield than Spain. So there's a huge sea change in the risk profile or risk tolerance for people. They've pressed this down. Now, I think the downside mostly to all this is generally things get pushed to this level because funds borrow money and they go buy stuff chasing yield until they get kind of squeezed. And that happened in the early 2000s. That led up to, part of the financial crisis was interest rates were low, funds could buy, borrow money cheaply and trade options and go and whack a bunch of calls and have fairly aggressive positions that started to get real ugly real fast when things changed. I don't know when that's going to change, but right now you could borrow money real cheaply. So, I mean, that's changing the curve on the upside for the indexes. There was a relatively flat skew, which kept VIX a little bit higher. And that curve is starting to drift down a little bit now. So all these little things sort of are adding up to lower volatility. And the perception of a shock is adding to lower volatility. So, at least for right now, the Fed somehow has done the great Houdini act on volatility in the market. After 5 years of what I would say is probably a pretty volatile market, or maybe 6 years really, they are moving back to what we just kind of have, we're a little sluggy as an economy, but, at least it's growing a little bit, not in the first quarter after everybody saw their income tax bill, but, it tends to be going in the right direction. So, but that's a big part of it is that I think a lot of that upside uncertainty that all this government intervention coming out of the market and sorting the market just be left to its own devices is probably one of the major factors over the last, I would say, 3 months on what's really kept vol going down and staying down. It just doesn't really bounce.
Well, jumping on to some other products, this is normally where I would dive into the metals, but we have a listener question about that, so I think I'll save that for that segment, and instead we'll move on to the other area of the commodity landscape that was exhibiting some vol these days, some serious vol, perhaps one of the few places in the market right now where you can actually find some decent vol. That was, of course, out in the land of crude. Of course, on the heels of what we were talking about earlier in the show about the recent developments out there in Iraq, spiking crude. You know, crude's been hovering below the 100 handle quite often over the past few months, and now seeing it spiking to the north. We saw crude on the NYMEX there spiking up over 107 a barrel. I think it's trading over 107 a barrel right now as we speak. And of course, Brent crude on ICE topped up over 114. I believe may have even touched 115 a barrel very briefly, trading right around 113 right now. So seeing a lot of movement, a lot of upside out there in crude. Not surprising as these militants start to move their way south. Of course, the southern part of Iraq is where a lot of the oil fields are. So they haven't really moved into that region yet, but perhaps just the looming threat, any sort of threat to that area is going to put a little bit of juice into oil vol. And of course, our old friend OVX, that is the VIX on USO, gapping up 5 handles this week to 19.5. I believe that was on Thursday, actually. It gapped up that far. We tend to take a dim view on USO here on the show for a variety of reasons we've outlined in the past. It's not really a good indicator of what's going on in oil. It doesn't track oil very well. So our viewpoint on the implied vol of USO is going to be somewhat less than charitable perhaps as well. But still, from a relative movement perspective, that's one of the biggest moves you've seen in implied vol out in USO in quite some time. Andrew, I know you take a dim view of USO as well, but I'm sure a lot of your clients over there at Option Pit right now are starting to look at what's going on out there in oil. If they're looking for return, if they're looking for vol, if they're looking for ways to generate some actual income in their portfolio these days. So what's catching your eye out in oil land right now?
Yesterday what was amazing is how while the vol jumped, it still was really low. I mean, it's still in like the low 90 percentile or the lower 10 percentile, I guess, of volatility. We had a pretty big jump yesterday. And as amazing as it was, it jumped to like 19%. If you look at a 2-year chart of oil volatility, it barely got up off the floor. Amazing. So again, there is just not a lot of, there is not a lot of volatility in these markets, even with a product like USO. And I'm still trying to figure out why oil is trading, at 100 plus, however much it's trading, depending on what you're looking at. But something like USO is trading near 39 and change. And it was trading just over 33 at the beginning of the year. Crazy. But there's very, very, very little implied vol in oil relative to what should be happening. And even today, volatility is down after, jumping yesterday. So just really, I'm a little amazed that the market is feeling zero threat to the price of oil from all this. You got a bunch of militants running around in the desert. I'm shocked, but hey, that's what we got.
You're right, though, Andrew. It's been oil implied vol, both in crude and Brent oil, hasn't moved as much as we might think from the percentage change numbers. I mean, we're talking about late August, or most of August levels, really, right now in these options. I think it's worth keeping an eye on, though, at least in terms of the price of oil. We've got all this great consumer data that's been coming out this year, and I can't think of anything that would kill it faster than consumer demand, that is, than $110 oil and high cost of gasoline putting a squeeze on those same consumers. So, I don't think that, the Fed doesn't want to see, they want to see inflation, but they don't want to see supply side inflation for sure. And I don't think the administration wants to see anything like that either. So I have to imagine that if we did see oil continue to rally, that it probably wouldn't be that short-lived before some policymakers might step in and do something. And that makes me think that if you do see a continued spike in oil implied vol, it's not likely to be that long-lived.
Yeah, and just looking at the oil infrastructure out there, a lot of people have been commenting of late that we've also seen some big players out there in the liquidity providing side of oil taking on the chin, and as a result, getting the heck out of Dodge. So people are also commenting that those markets a little bit thinner than they have been in recent years. So that also could be contributing to some of the move we're seeing out there these days, and could perhaps translate into some more volatility in these products going forward. Something definitely worth keeping an eye on. While we keep on rolling right on into our next segment, it's your segment. It's time to check the volatility voicemail.
It's time to share your thoughts and opinions with your fellow volatility traders. It's time to check the volatility voicemail. Make your voice heard by dialing 779-669-4VOL. Posting a comment on the optionsinsider.com, sending an email to questions@theoptionsinsider.com, or posting your questions to twitter.com/options or facebook.com/theoptionsinsider.
All right, everybody. A lot of great ways to get in touch with us here on the old volatility voicemail segment, including, like I said, at the top of the show, the app. I said, why make people remember the phone number? They can just hit the button and leave us a voicemail directly through the app. So check that out, listeners. A really cool way to be part of the show, just like some of our listeners did here today, starting off with a listener goes by the handle Indigo Blue here. I think we'll start off with the metals, guys, because we were just talking about oil. He writes, what's up with gold volatility? Well, that's a good question. He goes on to write, the contract is selling off like mad, and yet volatility is at near record lows. I've been taking advantage of this opportunity to load up on some gold premium, primarily verticals. I've also been thinking about ratio/repair trades in the gold futures options. Thoughts on this crazy gold volatility environment? Well, it is interesting, Mr., or I should say Mrs. Indigo Blue, I can't say for certain, that what we've seen out in gold volatility of late, you're right, it is at record lows, but I don't think it's that unusual. I mean, whenever you see protracted moves like this, eventually the vol starts coming off, particularly if it's kind of expected and what people have been anticipating. You know, in the early parts of that move where it was a little bit more aggressive, we did see vol spike a bit, but as it continues and the move was protracted and a little bit slower, and it seemed like gold has kind of found a bit of a support at these levels these days. It isn't selling off as dramatically as it was. I don't think it's that surprising that we're seeing gold vol coming in a little bit, maybe at historic lows. I guess you can probably take issue with that, whether it should be that low or not, but it's not that surprising that we're seeing gold coming off a little bit here. I know, Andrew, you guys are big fans of GLD, and a lot of your clients and mentees over there are pretty active out there in GLD. So what do you have to say to our friend here, Mr. or Mrs. Indigo Blue?
Well, generally, vol in gold doesn't go up unless gold is going up, when the gold bugs come in. Usually, if you're seeing vol sell off in gold, even just a little bit, that's usually kind of bearish for the metal. I don't mean like bearish as in what we saw last year when the Fed was going to start to jump out of the interest rate or stop stimulating the economy, when we went from like gold, 1,600 to 1,200 in about 2 days. That's tremendous realized vol, and implied vol is going to go up. But when gold really doesn't have when it's looking weak or they're starting to sell the vol, that usually means it's going down. So gold actually trades a little different from a vol perspective because all the skew is sort of bent upward in that thing. So usually when volatility in gold is going down, gold is going down with it, and it just sort of peeps along and creeps along. And I think the only real reason why it's up at all this week, even after some of the numbers we had last week that looked like we had some growth, again, Fed keeping to get out of the economy, but is, this Iraq thing, maybe probably put a couple of bucks under the price of gold here for the last couple of days.
That's a good point. A lot of the listeners of this program and a lot of traders in general come to the commodity markets with their embedded equity options perspective. So that, of course, means they come to these products expecting investment skew. They expect vol to come off to the upside and to spike to the downside. That's the way most equity and index products are shaped from a volatility skew perspective. And yet in the commodity landscape, completely different ballgame. Upside is typically where the fear is. So as you start dropping down, you're not going to see moving into those high implied volatility strikes like you would in an equity or an index. So this maybe is indicative, Mr. or Mrs. Indigo Blue, of perhaps adjusting your investment skew, your equity option mindset to trading in these products. I know GLD is an ETF. You can put it in a securities account, but it still is a commodity at the end of the day. So you need to do some commodity-esque thinking when you're trading these types of products. Jared, anything to add here on what's been going on out in gold vol?
No, I mean, I don't know why people are buying gold except for a trade still, but I have no qualms with people who want to trade it for something short term. But I don't have anything to say about what drives the price of gold or its long-term value. I think Andrew's exactly right, and you guys have it on the nose about the way volatility reacts there. So that's it.
So I should unsubscribe to your gold trading newsletter then?
Yeah, my Gold Bug monthly. Yeah, no value there.
Yes, I noticed it has been a little quiet of the last 6 months or year or so. I haven't been getting my updates from you. All right. Speaking of updates, we have probably an inevitable question. We get a few of these, seems like every week. We surface one or two every now and then. This one comes in from VIXinator. I like the handle. He writes, do you think this is a good environment for a cheap VIX vertical, maybe July 1620 for 35 cents, or perhaps looking out to the SEP 1720 for 60 cents? I guess that depends really on what your point of view on cheap is, whether these are cheap or not. Andrew, I'm sure you get this question about 47 times a day. So why don't you start off with our friend here, Mr. VIXinator?
I don't know. Maybe it's a waste of money.
I'm glad you said it and not me. I'm tired of saying
Just
that.
take your money and throw it out the window. You'd be better served on maybe buying short-term puts in the VIX, cashing in on the roll yield, and then, buying some of these call spreads for protection out there. Buy, maybe you could get a little wider call spread, maybe a little closer to the money, and then lean on the puts you buy in the VIX to take advantage of the roll yield. That way, if VIX does blow up, your call spread should easily pay for, the put you got drilled on. But in the short term, the puts will probably make you money, 3 out of 4 months. And the one time you need it, the call spreads, they'll be there for you. So it's just, the only way you buy call spreads in the VIX is if you're long. I would say have long equity exposure somewhere else or something like that. And you're taking your dividend income from those equities and you're going and taking on blowing some call spreads in the VIX. But other than that, what you're saying is when is the volatility going to come back? Right. And well, we just had a kind of, I would say, what a nasty geopolitical event, and we got exactly bupkis out of volatility. I mean, it moved from 11 to 12, but it's already going the other way again today. So you're gonna need a huge move to make some money on those type of call spreads when you think about it on a percentage basis. Something really nasty has to happen at this point. So they are, they're 50% out of the money. You gotta think about that. You need to stay involved for those call spreads to pay. And right now, I wouldn't use my dollars to do it.
I wouldn't touch that with my wallet. But this kind of goes back to what we've been talking about on the show a lot about the subtle and perhaps hidden carrying costs of this quote unquote low volatility environment, and people keep beating this drum about reverting to 20. These types of trades would definitely fall in that category of that carrying cost, because these are probably going to go out worthless. So if you're ponying up this money for these call spreads, whether it's very near term in July or a little bit farther out in SEP, you're probably going to be, hopefully this is money you can afford to burn, and B, I tend to, like I said on the show many times in the past, I tend to fall in the Andrew type of camp as well. I prefer the more direct type exposure in the S&P downside. And if you want to play a little bit in VIX, it's good for a kicker, but I wouldn't use it as my primary way to trade this environment. I'm glad Andrew got to say it this time instead of me. I get to take a little bit of a break from dismissing VIX calls. All right, moving on to a question from Andy Braga. He writes, what do you think about Apple as a dispersion candidate going forward? Do you think the split will take the wind out of its sails from a volatility perspective, or is it perhaps more attractive here? Well, this is actually kind of like two questions in one. Maybe we'll tackle the first part first. Those of you out there who are not familiar with dispersion trading, it's essentially trading index vol against the individual components of that index vol. And Apple, of course, being a primary component of S&P vol, a primary driver of that, it's been a very popular trade for dispersion traders out there the last couple of years. In fact, it's been one of the primary trades that a lot of shops have clung to in order to keep the doors open, as volatility and liquidity in other products has tended to dry up. Jared, maybe we'll start with the first part of the question first. We'll start in order. What do you think of Apple as a dispersion candidate here? And do you think the split will perhaps take some of the luster off of it in that area?
Okay, I don't think that splitting the stock has any economic impact whatsoever, or reverse split also doesn't have any economic impact. I guess it could have some psychological impact on the margin if there are people who would love to buy a share of Apple, but couldn't at the previous price, but by definition, those would also be participants who would be unlikely to have a discernible market impact overall. So no, I don't think the split means that much in terms of long-term economics for the stock, and then like kind of naturally feeding into the question of how it works as a dispersion candidate. I don't know. I mean, Apple's owned by so many big funds, and it's such a core holding that it's hard to. I've never really stopped to think about whether it's going to be a good candidate as a dispersion trade. It's not like, I mean, the company itself is kind of running up against the limits to its size, the limits to growth, as it were, and having a harder time generating the kind of month-over-month, year-over-year growth that it was able to do 5 years ago. So, and for all those reasons, I mean, it's just such a large behemoth, widely owned, that I'd probably take the other side of whether Apple's going to work as a dispersion candidate, maybe look somewhere else in tech.
Yeah, I would agree with Jared there. Apple's kind of already an index. I mean, it is the Nasdaq. Actually, most of my clients are just kind of bummed out they split the stock because they screwed up the risk reward profile on all the cool short gamma trades you could do in there. So it's a kind of a bummer, to be honest. It's not really showing a whole lot of volatility right now either. Normally, I would say back in the go-go 90s when they split a stock, huge for volatility. They split Amazon from 400 to 100. The next day it was up $25. So we're not, though, in 1998 either. Usually, just because the stock's a little lower, you will see on the mathematically a little bit more volatility because a $1 move is a lot different when the stock is 7 times or 1/7 the price. We're seeing a slight blip in realized vol for Apple. We're not seeing a huge blip in volatility for Apple, but it's still, it's down 94 cents today. That's a $7 move back in the old days. So it is moving around a little bit. Is it as fun to trade as it was before? I'm going to say for the most part right now, no. And really, I think a lot of clients are just getting used to, what to do with it now at this point, or how to basically generate, the positive theta trades that they used to like. So it's just not there. It's kind of just a stinky $90 stock now. Doesn't mean it's not a good company, but as a trading vehicle, it's not quite as appetizing as it used to be. Probably moving on to other stuff like CMG or something like that.
The stealth Apple, one of my favorites. All right, and that's going to do it for the old volatility voicemail. And now we're going to roll on into our final segment, the crystal ball.
It's time to peer into the future and reveal what the volatility gods hold in store. It's time to look into the crystal ball.
All right, everybody, you know what that sound means, or what that transition means. It's time for the crystal ball, where we look into the future and prognosticate wildly and perhaps even recklessly on what the vol gods may have in store for us in the coming week. And if the coming week is anything like the last few weeks, I think we can all pretty much know where we're headed. But nonetheless, let's dive in recklessly. Andrew, we'll start with you. What do you think is lurking in store for us for the coming week from a volatility perspective?
For me, I always liked it when the U.S. goes in, because I know for sure vol goes down after we start dropping some bombs. And the press conference I saw today didn't look like that was going to happen this weekend. So what it does is I think it makes the volatility less likely to go down fast in the near term. Although I would say, unless those southern oil fields get taken over and the rebels invade Kuwait, we're probably going to see lower vol next week from here. I would not be surprised if, we see something around, 11 and a quarter again, something like that for VIX.
Jared, take us home. What are you watching for the coming week from a vol perspective?
So the Fed meets next week, and everyone expects $10 billion reduction in large-scale asset purchases, just like the last 2 meetings. And that's probably the best expectation to have. But there's always a chance that given the positive data that we've seen, including revisions over the last month, that they might get a little bit more aggressive in the pace of those reductions. In that case, the market might not like that very much. You might also see language, outside chance, you might see language of concern about the levels of asset prices. I thought it was interesting that this year now you've seen people at both extremes of the Fed governor camp, from Fisher at the one hand to Coach Lakota on the other hand, mentioning that the policies that the Fed has been doing, whether they like them or not individually, may be currently and maybe in the future associated with instability in financial markets, and that might just be something that we have to accept in the future to achieve their policy goals. So I think there's room for some kind of outside Fed, either a policy change or a language change, getting markets woken up a little bit in the very short term. And so we've been looking at some very, very targeted hedging trades to deal with that possibility for next week. I don't expect much out of Iraq. I think this is something that'll be, not something we're thinking about 3 months from now. And otherwise, everything's looking pretty good.
All right. And unfortunately, we'll have to leave it there. That is all the time we have. But before we go, really quickly, let me check in with each of my cohorts here on the old Volatility Views panel. See what they have coming down the pike that may interest you, the listeners, until the next time we can all gather together here on the old program. Jared, perhaps we'll start with you. What's coming down the pike over there at BGC Partners?
So our equity derivatives desk just put out a nice piece this week on a volatility risk premium strategy, trading options in VIX, and actually some VXX as well, that we sent out to clients. It's gotten some good feedback and has been well received so far. I just came out with the volatility tracker note for this week today, and we're actually going to be launching soon a piece that does some scans and some looks at equity and ETF options as well, looking at skew and some other metrics to expand the scope of coverage. And there's some larger research projects for the longer term kind of on the back burner that I'm working on as well.
Great stuff. If you want to learn more, listeners, of course, surf on over to bgcpartners.com. All right, and Mr. Rock Lobster, what's coming down the pike over there at the pit?
Mark has rejoined us full-time at Option Pit. We have our chat service, which is now kind of up and running, and it's working nicely. We have we have about one new person drop in per day. And we basically have been talking about markets, looking at trades. Mark goes about reading order flow. It's been a great. I think our clients enjoy it, so they keep coming back every day, which is good. Also, I will be posting a webinar that I did for a Trade Monster on our blog today about trading in a high vol environment, where you can download that and check it out. If you want, I will send you the slide deck. Just ask me at andrew@optionpit.com. That was pretty well received. And lastly, we do have a webinar coming up with Trader Planet in July. You will see something about that soon. Hopefully, I'll have that date squared away for you, but I believe mid-July. I don't know what the topic is yet, but that's what we got going on, and things are moving along in Option Pit.
Sounds good. All right. And on behalf of Jared and Andrew, and of course myself, I want to thank all of you out there in the listening audience for downloading and streaming and subscribing to the program, for sending in such great questions. Keep them coming, and we'll see you next time right here on Volatility Views.
Thank you for listening to Volatility Views, the premier program for volatility traders. For episode archives and detailed show notes, please visit theoptionsinsider.com/volatilityviews. Be sure to make your own voice heard by leaving a volatility voicemail at 773-669-4VOL. or by posting a comment on theoptionsinsider.com, sending an email to questions@theoptionsinsider.com, or posting your questions to twitter.com/options or facebook.com/theoptionsinsider. Volatility Views is brought to you by Russell Investments, a global asset manager and one of only a few firms that offer actively managed multi-asset portfolios and services that include advice, investments, and implementation. For more information on Russell Indexes and RVX, please visit russell.com/indexes.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.